I get asked all the time whether it's a good idea putting an investment property into a trust. So in this video, I'm going to share what a trust actually is, what are the pros and cons of using trusts as a part of your investment strategy, what are the tax considerations of operating a trust, and finally, what other factors you need to consider whether this strategy is right for you. A trust is a really confusing thing. It's not a legal entity in its own right. You are a legal entity, a company is a legal entity, a trust is not. By definition, a trust is a legally recognized relationship between a trustee and trust beneficiaries. But that's still confusing. So here's the explain to me like I'm 5 version. A discretionary trust is kind of like a special box that you put your money or your property into. But instead of keeping the money or property for yourself, you give the box to someone who takes care of it for you. This person is called a trustee. Now, the cool thing about this box is that you get to decide who gets the money or property inside it. You can choose to give some to your friends, some to your family, and some to other people that you like. And you can even change your mind about who gets what later on. But there's a catch. The trustee gets to decide when and how much money or property to give to each person. They'll look at your instructions and decide what's best for everyone. So you have to trust the trustee to do a good job. Haha, trust. So why do people actually put their properties into trusts? Well, there's 3 key benefits that I've come up with. The first is asset protection, the second is flexibility, and the third is estate planning. Tax is also a massive benefit, but that gets its own chapter later on. You work hard for your money and your assets, and you don't want them taken away in case something goes wrong. If you do get sued, a creditor can seek a court order to seize your assets for any debts or damages that you owe. There are a number of reasons that you could get sued, but some of the more common ones are if you owe money and you're unable to pay back, if you breach a contract or an agreement, or if you cause harm to someone or their property. There's a saying that goes, own nothing, control everything. And that's what a trust lets you do. A trust lets you have control over a property without having its legal ownership. Trust assets are technically held by the trustee. So if you have a good accountant and they set you up properly, they will set up a corporate trustee, which is where a company is actually acting as the trustee of your trust. This just gives you another layer of separation from the trust assets. So if you're sued for your assets, the trust assets are separated and they're safe. The second big benefit of trust is flexibility. Trusts aren't regulated by ASIC like companies are. Instead, trusts make up their own rules. This is done via a trust deed, which is a unique set of rules which sets out what can and what can't be done via that specific trust. And the last benefit is that a trust allows for really good estate planning. The control of the trust can be transferred from one generation to the next without incurring any capital gains tax or paying stamp duty. A trust will generally minimize legal disputes and just sort of overall simplifies the transfer process. But there are some limitations to trusts, namely that negative gearing concessions don't apply, and it is more costly than just purchasing an investment property in your own name. One of Australia's best tax concessions is negative gearing, which is where a rental property that produces tax losses, you can actually use those tax losses to offset any other taxable income that you have, such as your payee salary or business income. If you use a trust, the losses will actually be trapped and cannot be distributed to beneficiaries. Instead, the trust losses will be carried forward indefinitely until the trust actually produces enough profits to offset the losses. How much does it cost to set up and maintain a trust if you're purchasing an investment property? The initial setup is anywhere from $2,000 to $3,000, and then every year after about $1,000 plus. It's definitely more expensive doing it this way than it is just purchasing in your own name, so it's best to weigh up whether the tax savings and all the other benefits outweigh the cost. Trusts don't pay tax. That's a little bit misleading. Trusts don't pay tax in their own right. Individuals pay tax, companies pay tax, trusts don't pay tax. Instead, what actually happens is the profits that a trust produces is given to the beneficiaries and they pay the taxes. So if a trust makes a profit, it distributes to its individual beneficiaries, they will pay the tax. Or if the trust makes a profit and distributes to company beneficiaries, they pay the tax. So you can get clever by sharing the trust profits around with other beneficiaries who might be in lower tax brackets. Therefore, you're reducing the overall tax paid by that rental property. But another great feature of the trust is the ability to access the long-term capital gains tax discount. Quick refresher, when you hold a capital asset for greater than 12 months and you sell it for a gain, you can discount that gain by 50% before you pay tax on it. In the same way that the trustee chooses who gets to pay tax on their income profits, The trustee can also choose who pays the tax on the capital profits. So if a capital gain is distributed to an individual, they will pay the capital gains tax, and they will calculate if they're eligible if they can discount it by 50%. One last thing to note with taxes: in some states, the tax-free threshold for land tax does not apply to properties held in trusts. So do your own research into the states that you're going to be purchasing in to see whether they will calculate properties in trust towards land tax. If I were in your shoes considering purchasing an investment property in a trust, here are the 4 questions I'd be asking myself. The first is the property likely to be negatively geared? If it is, maybe I'd want to make the most of that and just keep it in my own name so I can offset my other income. The second is, can I legally distribute income to beneficiaries in lower tax brackets? If you don't have family members who are in lower tax brackets, then maybe a trust just isn't right for you. It's not worth the hassle. 3, am I likely to get sued considering all my other activities? So look at your work, look at your business, look at your insurance policies. If you're all pretty safe, maybe asset protection just isn't that important to you. And 4th is, what are my retirement and estate planning goals? Am I intending to keep this property forever and hand it down the generations? If so, maybe a trust is appropriate. The thing I'd actually be worried about most is capital gains tax, because it's going to be the biggest bill that you're going to pay. So if you want to learn how to pay $0 capital gain tax when you sell an investment property, watch this video next.